Hours of February 24th, 2022. The world didn't just witness the return of conventional warfare to Europe. It witnessed an instantaneous, violent repricing of global risk. Within minutes of the first missile strikes, trillions of dollars in market capitalization began to evaporate. Brent crude surged past $100 a barrel. European equities entered free fall, and the volatility index spiked to levels not seen since the height of the pandemic. For decades, investors had operated under the assumption that major geopolitical conflicts were isolated events, regional tragedies that would not derail the global financial engine. That assumption was shattered overnight. This was no longer just a diplomatic crisis. It was a capital shock. It forced central banks to scrap their forecasts, corporations to write off billions in assets, and portfolio managers to realize that in an interconnected world, a tank crossing a border in the east can instantly liquidate wealth in the west. This is the story of how the Russia-Ukraine war dismantled the old financial order and forced the world to pay a new, permanent premium on risk. To understand the magnitude of this financial earthquake, we must look at the fault lines that existed long before the invasion. Following the collapse of the Soviet Union, the global economy was built on a premise of integration. Western capital flowed east, seeking yield and resources, while Russian commodities flowed west, powering European industry. This symbiotic relationship was most visible in the energy sector. Germany, the industrial engine of Europe, built its manufacturing dominance on cheap Russian natural gas. Ukraine was the critical artery for this trade, hosting the vast pipeline networks that kept European lights on and factories running. Simultaneously, the expansion of NATO was viewed in Western capitals as a security arrangement, but in Moscow it was interpreted as an economic insurgency. As the alliance moved eastward, the Kremlin perceived a threat not just to its borders, but to its ability to control energy leverage over Europe. Ukraine sat at the intersection of these tensions, holding a unique position in the global supply chain. Beyond energy transit, Ukraine had quietly become an agricultural superpower, often called the breadbasket of Europe, dominating global exports of sunflower oil, corn, and wheat. The first tremor occurred in 2014 with the annexation of Crimea. At the time, global markets severely miscalculated the long-term implications. The response was muted. Sanctions were targeted and limited, and capital markets quickly returned to business as usual. Investors treated Crimea as a localized geopolitical dispute rather than a systemic threat to the European security architecture. This complacency created a false sense of security, leading to a decade where European dependence on Russian energy actually increased rather than decreased. The markets had priced in peace, leaving them completely unhedged for war. That complacency evaporated in early 2022, as diplomatic talks broke down and troop buildups were confirmed by satellite imagery. The risk-on sentiment that had driven the post-COVID recovery began to crack. When the invasion commenced, the financial reaction was mechanical and brutal. A massive flight to safety ensued. Investors dumped risk assets and piled into U.S. treasuries, gold, and the U.S. dollar. The euro plummeted, reflecting the realization that the Eurozone economy was on the front lines of an energy war. The immediate impact was a supply shock that the modern market was ill-equipped to handle. Energy markets went parabolic. The price of natural gas in Europe spiked to astronomical levels, threatening to deindustrialize the continent's largest economies. This wasn't just about the cost of petrol at the pump. It was about the input costs for chemicals, steel, and fertilizers. The electricity pricing mechanism in Europe broke down, forcing governments to intervene with massive fiscal subsidies to prevent widespread insolvency among utility companies and households. Simultaneously, the commodity complex experienced a limit-up event. Because Russia and Ukraine combined accounted for nearly a third of global wheat exports, food security became an immediate financial risk. Prices for staples soared, sparking fears of famine in emerging markets and inflation in developed ones. The shock extended to niche metals. Palladium, essential for catalytic converters, and neon gas, critical for semiconductor manufacturing, saw supply chains severed. The war highlighted a terrifying reality for globalized trade. Efficiency had come at the cost of redundancy. In the equity markets, a violent sector rotation took hold. The high-growth technology stocks that had dominated the previous decade were suddenly sold off. In their place, capital flooded into the energy and defense sectors. Defense stocks, which had long been shunned by ESG, environmental, social, and governance funds, were suddenly reclassified as essential for protecting democracy. Major arms manufacturers saw their valuations soar as nations across Europe pledged to increase military spending to levels not seen since the Cold War. The currency markets became a battlefield of their own. The Russian ruble initially collapsed, losing nearly half its value in days as Western nations imposed unprecedented sanctions. These measures included freezing the assets of the Russian central bank, a move that shocked the financial world. It signaled that foreign exchange reserves, traditionally considered the safest of assets, could be rendered useless if a nation violated international norms. However, through strict capital controls and demanding payment for energy in rubles, the Russian currency artificially recovered, though it ceased to be a freely traded instrument. Meanwhile, the US dollar surged, reasserting its dominance as the ultimate safe haven, crushing the purchasing power of emerging market economies that held dollar-denominated debt. The bond market faced the most complex dilemma. Typically, a war triggers a recessionary fear, leading to lower interest rates. However, this war was inflationary. By choking off the supply of energy and food, the conflict poured fuel on an already overheating global economy. Central banks, led by the Federal Reserve, found themselves in a nightmare scenario. They had to hike interest rates aggressively to fight war-induced inflation, even as the war threatened to tip economies into recession. The era of transitory inflation was officially dead. Bond yields spiked, causing the worst year for fixed-income returns in decades, destroying the traditional 60/40ths portfolio strategy that had protected retirees for a generation. The human cost of the war translated directly into a grim economic reality. The resulting inflation crisis triggered a cost-of-living squeeze worldwide. Real wages collapsed as the price of heating, transport, and food outpaced income growth. Consumer confidence hit historic lows, forcing households to burn through savings. For the corporate world, this meant margin compression. Companies could no longer pass on all their rising costs to consumers who were already stretched thin. This triggered a wave of layoffs and cost-cutting measures, particularly in energy-intensive industries. Furthermore, the corporate exodus from Russia represented a historic destruction of shareholder value. Western giants, energy firms, automakers, consumer brands abandoned billions of dollars in infrastructure and market share overnight to comply with sanctions and protect their reputations. The global supply chain, already fragile from the pandemic, fractured further. The concept of friendshoring, trading only with political allies, began to replace the concept of globalization. Investors were forced to adapt their strategies in real time. The playbook of the last 30 years by the dip, trust in low inflation, and ignore politics was thrown out. Institutional investors began structurally de-risking their portfolios. There was a renewed focus on hard assets like commodities and real estate as a hedge against geopolitical inflation. The calculation of risk premium changed fundamentally. Investing in autocratic regimes or politically unstable regions now carried a much higher cost of capital. As the dust settled on the initial shock, a new reality emerged. The Russia-Ukraine war had ended the era of the peace dividend, the economic boon the world enjoyed after the Cold War, where defense spending could be cut and global trade could flourish without friction. Markets must now price in a conflict. In conclusion, the financial legacy of the Russia-Ukraine war is not just found in the charts of 2022, but in the permanent alteration of investor psychology. The war demonstrated that the global economy is not a self-correcting machine independent of political will. It showed that access to capital markets is a privilege, not a right, and that the plumbing of the global financial system can be weaponized. For the modern investor, the lesson is stark. Geopolitics is no longer background noise. It is a core variable that determines the solvency of nations and the value of portfolios. The illusion of a borderless, purely economic world has been shattered, reminding us that when politics and capital collide, capital is always the first casualty.